All right, everybody. Let's have a little talk about next week. Um, at the last group of FOMC and PPI and CPI, I really think that there wasn't enough said about the risk and the danger. And I heard a lot of people say they really got ran over, that the the risk wasn't really highlighted enough. So let's do that. We have our PPI data from this week, and it wasn't that bad, right? We're considering, what it could have been. It wasn't that bad. Now, I'm going to turn those lines back off for a moment. We don't really need them right now. What we're looking at is a weekly expected move. On Friday, after the market closes, we get next week's range. That's why there's no candles in there. This is an indicator that Mobius made to kind of mimic what we get when we look at the options chain here. It's trying to give you this information. The thing is, on Thinkorswim, you cannot access this information with code. So he did a really good job of demonstrating that weekly expected move, but it's not perfect. And his code does not touch this. And that's what it's trying to mimic. In a good market, in good, clean, bullish price action, it's going to be fairly close to accurate. But that's not the kind of market we're in. The expected move for next week is $127 higher or $127 lower than our current location. And by that, I mean by where we closed on Friday. We closed at 39.34. Add 127 to that. It gives you 40.61. So let's go back out to the chart. We'll just draw a line. You see where my green line is? It's higher than where that indicator drew its line. That's how far off the calculation is this week. So as we come into next week and we have CPI and we have FOMC, this indicator is not demonstrating to you the level of risk that is in front of you. All right. Now, this is a one standard deviation move. We haven't even gotten into something like a two standard deviation move or a three standard deviation move. We're only looking at what a one standard deviation calculation is from the close. So let's go back in here and get the downside. And it's still moving, right? If we wanted to be really accurate with this, we would have wanted to get it Friday at 4:15. That would have been the time to get it. But this is close. This will do us 38.07. So now we've got our range for a one standard deviation, and we're looking at 3,800 to the downside and 4,050 to the upside. It's a 250 point move. It's actually a little more than that because I'm rounding. But that's next week's one standard deviation expected move. How you feeling about that? Now, the next thing that I heard a lot of people say is, well, everybody was really bearish or everybody was really bullish. All the indicators said that we should be positioned short or positioned long. This is a binary event, and I speak about binary events in my morning briefing, but the main takeaway is it's ones or zeros. It's yes or no. It's up or down. That's a binary event. There's no gray area. There's no ambiguity. There's no wishy-washy feel-good place. It's either going to go up really big or it's going to go down really big. What we will not see is a doji week. We're not going to end the week where we started. That's off the table. That's not going to happen. So you have to be positioned to withstand a significant move in either direction. And there is no way to tell which direction we're going to go. No chart data out there is going to tell you what the numbers are going to look like. So it doesn't matter how much technical analysis you perform on the chart. The only thing that's going to matter is when Powell comes out, chipping his teeth, and what he says about the next FOMC meeting. What we're looking at is the December 14 FOMC meeting. Our current target rate is 375 to 4. Usually I just say 375. The expectation is a 78% chance that we are going to get a 50 basis point rate hike for the December 14 FOMC meeting. Could he surprise us with a 75 basis point rate hike? Yes, he could surprise us with that. There is a 21% chance that he will do that. Now, between the Friday close and next Tuesday, we could see this number change. We could suddenly see a radical shift and start to see this number go up drastically and this number go down drastically. But at the moment, we're not seeing that. Okay, so the expectation is for a 50 basis point rate hike on Wednesday. That's not a surprise. And you can see that it's been maintaining a 75 basis point or a 75% chance of a 50 basis point rate hike since December 2, the first of the week. Over the last month, it decreased only a little bit. A month ago, there was an 85% chance we were going to get a 50 basis point rate hike, and we're still sitting at a 78% chance. Okay, so we have a pretty good idea because Powell has already come out and said it's going to be a 50 basis point. Well, he didn't say it's going to be. He said it's very likely going to be, right? He left himself a little bit of wiggle room there. He said it's very likely going to be a 50 basis point rate hike. So he has the potential, because of what we've seen with PPI this week, to actually bump that up to a 75 basis points. But let's just suppose he doesn't do that and just leaves it at 50. We've all heard now for a month that it's going to be 50. Powell himself has winked and nodded and said it's going to be 50. So we're going to expect a 50 basis point rate hike. That's not going to shock and awe the market. The only thing that's going to shock and awe the market is what he says when he opens his mouth about the next meeting and what they're going to do going forward. And that is not on the chart. So no amount of technical analysis, macro, micro, mini, it doesn't matter what you look at. The only thing that matters is what he says. And we cannot anticipate what he's going to say by looking at a candle chart. So you better be prepared for a really big move. And if you're not prepared for that really big move, consider getting out of your trades and then perhaps getting back in afterwards. Okay. If you have positions on that are just slightly profitable or maybe just slightly in the losing category, but they're not really, doing anything for you yet and they're close to your break-even areas, consider getting out of those. I know a lot of traders want to catch these big move events. And I get that when you can put some edge to it and you kind of have an idea that we're going to go up, or you kind of have an idea that we're going to go down. Do you have any idea what the man is going to say? No. And I don't either. Nobody out there knows. Right? So how can we position for that? This is a 1 standard deviation move that I marked out. Let's just suppose that we go a little farther than a 1 standard deviation move. Notice, by the way, how far the market went outside of the expected move this week, the week that we just had. We had PPI on Monday. That took us to the very edge of the expected move in one day. And then on Tuesday, we were out of the box completely. And we stayed out of the box the whole week. But that's the indicator that Mobius made. And I would argue that wasn't our real expected move last week. If we had hand-drawn those lines, I bet they would have been farther down. So we're still outside the box. But let's see what a 2 standard deviation move would look like. Since it's the weekend, Thinkorswim is doing updates. and I can't get it to display the standard deviations within the options and analysis area. So I swapped over to Tastyworks. If you're unfamiliar with Tastyworks, just to give you a little bit of a guide on what we're looking at, let me bring the strikes down a little bit for a moment. Orange line is at the money. You can see in the middle how many days to expiration. So we're 6 days to expiration. The expected move for next week, $122. Now, what's unique about this broker is when I turn the strikes back to all, see this orange bar here in the middle. This orange bar is going to highlight that $122 expected move. So it gets us to the edge, 40.55. But then we have this blue dotted line right here. That's a 1 standard deviation move within the options chain. And it's showing 40.75 because this is expected move based on implied volatility values. And this is a 1 standard deviation based on implied volatility. Okay. So they sound the same kind of, but they're just a little different. The main thing is we want to know if things got rowdy this week, what could be the upside move in measurement? Well, if they have one line showing a 1 standard deviation, we just keep going out of the money and we find their other line. That's the 2 standard deviation. Now, I want you to draw your attention to the number here, 42.25. This is telling us that if we make a significant upsize move this week, we have the capacity and the potential to move up to 42.25, and that would not be considered out of line. It wouldn't even be considered extreme. It would be a 2 standard deviation move. Now, that's your upside move, 42.25. Let's go back to Thinkorswim and put that line on the chart, 42.25. Now let's get our downside. Here's the second line to the downside. It's a 2 standard deviation move set within the options chain, 36.45. Now, what I want you to think about is how is your account going to survive, or what will happen to your account if the S&P makes that big of a move this week, to the upside or to the downside, because that's what's on the line this week. Am I saying we're going to move that much? No, I'm not, but I'm saying we have the potential to move that much. It's within our measurement from 42.25 all the way down to 36.45. That would not be considered out of line because that's what's on the line this week. There is an indicator on Thinkorswim called cone of expiry. Now, what this cone is, and it doesn't necessarily work on spot on SPX, so we got to go to SPY. What this cone is designed to do is show you on a month-to-month basis how far we could go. Now, thankfully, because of where we're going to be expiring this week, it lands on one of those monthly expirations. So let's add some lines, go up to the gear, go to time axis, and we want to show expiration Friday, which is the 3rd Friday of the month. And now you can see that the red lines match where there is a price value. What this is telling us is next week, for a 1 standard deviation move, we could go in SPY up to 404 or down to 381. And now it says that we could go 416 to the upside and that we could go down to 370 to the downside. Are you comfortable with that kind of movement? This is the kind of move you need to be prepared for this week because this is what's on the table. Nothing else matters.